In this video, we're going to be discussing contingency provisions as they relate to fixed income securities. They're also known as, so AKA, embedded options. And we're going to discuss three categories or three types of embedded options, namely call options that may be embedded into bonds, making those bonds callable, put options, making the bonds putable, and conversion options, making the bonds convertible. So three options giving specific features to the bonds, making them different to the sort of normal straight type of bond. And let me say that these contingency provisions as such, what they do, so let's put a definition down, they are sort of provisions or clauses which are written into the terms of an issue, clauses allowing for specific action, which will depend on the type of option that's built in, be it call, put, or conversion, for specific action if an event or some circumstance occurs. Occurs. Good. We're going to start off with something called call options, which make the bonds callable. So if a bond has a call option built into it, it becomes a callable bond. And if that's the case, what can happen is the issuer has the right to basically buy the bond back, to redeem it, to redeem, or as we can say, call the bond ahead of its sort of standard maturity date. And this could be all or part of the bond in question, as I said, ahead of the maturity date. So you're effectively accelerating potentially the moment when cash is given back to investors. Now, bear in mind that the issuer can do this, has the right, but there is nothing obliging them to do it. So this gives the issuer some extra flexibility. The issuer has flexibility. There's nothing forcing them to take advantage of this potential right, has the flexibility to, now this is important, refinance the bond, refinance the debt at a potentially lower rate and at a lower interest rate. Whenever you see me write I/R, that's the way I write or I abbreviate interest rate. I'm going to put that down once, and then you should know from here on. You see, a lot of issuers issue bonds with fixed coupon. That's something we discussed before. And especially, government issuers, but lots of corporate issuers as well, issue bonds with a fixed coupon, and therefore commit themselves to pay that fixed coupon to investors for a specific amount of time. Now, if subsequent to this interest rates in the market drop, what a callable bond allows the issuer to do is kind of not stay stuck paying that higher interest rate, higher coupon, which was fixed at a time when interest rates were indeed higher, but take advantage of the fact that they can now go to the market, issue a fresh bond, meaning refinance their fixed coupon debt, taking advantage of the lower interest rates which now prevail in the market. Now, there are two types of callable bonds or calls which may be built into bonds that you need to know about. One, indeed, is going to allow the issuer to take advantage of lower rates, the other not necessarily so. Now, the one you really need to concentrate on is, first type, I'm going to call this a fixed price call. So the fixed price call is our first type, and then later on you're going to see a second type. I don't know where I'm going to fit it in yet, but we'll see. So in a fixed price call, the call price, that's the price at which the bond may be redeemed by the issuer, is, as the name suggests, is fixed or is predetermined. It's set up front, and it's predetermined in a schedule. So what you'll typically have is actually in the documents accompanying the bond issue, you'll already have the prices. And this is typically more than one price. So call prices are actually written out, and there's a schedule with accompanying dates. Because what I'm trying to get at here is, if you imagine a timeline, over here you've got the issue date. That's when the bond comes to the market, and obviously I'm talking about a bond which offers a fixed coupon. This is, kind of said this over here, but let's imagine you've got a bond that pays a fixed coupon. I don't know, once a year or once whatever period. What will often happen is, at least for some duration of time, the holders of the bond will receive their fixed coupon as promised, and they'll be protected from any attempts by the issuer to call the bond back, to redeem the bond. So you need to be aware of the name for this period. It's the call protection period, when the option to redeem the bond is not valid or not activated yet. However, following this, what starts is indeed the call period. This is when the issuer can redeem the bond at a predetermined price. And what will typically happen is, for every date, these often go hand in hand with the coupon payment dates, you're actually going to have a fixed call price. So this will be call price number 1. This will be call price number 2. So if the issuer wants to redeem the bond on this specific date, they'll have to pay a specific price to the investors to do so. If they want to do it on this date, well, there will be a specific price which is already written into the bond terms, into the bond indenture, the bond documents. There's nothing necessarily unknown about it. The only unknown is whether the issuer will want to take advantage of this. Typically, what happens is that over time, this call price becomes lower. So if the issuer wants to redeem their bond ahead of schedule over here, they'll have to pay a higher price than the price they'll need to pay later on. Typically, not always the case. Okay, there could be just one, let's say, call price written into the agreement. So let's think about this. Who is this actually valuable to or valuable for? Well, the call option, and this is something you need to absolutely appreciate, is favorable or valuable to whom? Well, to the issuer, or for the issuer, right? To or for the issuer of the bonds. And how valuable it is, so its value depends pretty much on a relationship that, once again, you need to get your head around. On the relationship between the coupon rate that's built into the bond, I'm assuming it's a fixed rate, So it's whatever coupon the bond pays and promises to pay versus what your curriculum describes as the YTM, the yield to maturity. And this is something you're going to have to compute in the exam, not as part of this learning module. We're going to compute this in later lessons. It's one of the most critical computations that we do in the fixed income section of the curriculum. But the YTM, well, let's introduce it very briefly right now. It's the yield, as the name suggests, yield to maturity, or rate of return, as you may say as well, a rate of return that is required in the market. Now, obviously, required in the market currently. Let me put that down in a bracket as well, currently. So what investors require as a rate of return right now. And obviously, the whole point here is that if interest rates in the market drop, as I was suggesting over here, people or investors in the market require a lower and lower return to satisfy their needs, given the risk of an investment. This is always obviously related to risk. And if it's so that the coupon rate, if the coupon rate that we are actually paying is lower than current YTM, meaning what kind of yield, what kind of rate of return would you need to offer investors if you wanted to refinance this issue? If you wanted to replace these bonds with new bonds that you would offer to the market. So this YTM, you can think of it as the sort of the current cost to refinance. What you would need to offer investors for them to accept freshly issued bonds, and the money from those freshly issued bonds would be used to repurchase these bonds, to redeem them, because you've got the option to do so, assuming your bonds are of a callable nature. Well, if the existing coupon rate is lower than current YTM, do nothing, right? Don't be naive. I was going to say something less diplomatic. Don't buy these bonds back, don't redeem them because you're paying a lower rate. However, if the coupon rate on the bonds you've already issued is higher than current YTM, then absolutely do go ahead and call the bond. Do a new issue at lower yield, offering investors a lower coupon, and taking advantage of that lower cost to refinance, replace the existing bond, buy it back, redeem it, call it back in the market, and get rid of the higher coupon you're paying. That's why we build these call options into bonds, because they offer us the possibility to do something potentially favorable. Now, if you think about this from an investor perspective, which is obviously going to be the opposite of the issuer perspective, well, a call option is detrimental to them. So always with these options, it's going to be positive for one side, but valuable for one side, but detrimental for the other. And the reason why it's detrimental is, well, it's because it introduces something that we're going to talk about later on in quite a lot of detail. It exposes us, or the investor, to what we call reinvestment risk. The risk that if interest rates go down, the bond is called. And, if the bond is called, the investor receives a a lot of money coming to them, but unfortunately in a lower rate environment, in an environment where they can reinvest that money at a lower rate than the rate they were receiving via the higher coupon until now. So this is, what the bond exposes us to, plus it exposes us to the fact that these bonds have limited price appreciation potential. Normally, when interest rates go down, and you're holding a bond whose coupon was fixed at a time when interest rates were higher. So, this is the time when interest rates were higher. We fix a coupon to satisfy investors' needs, and then subsequently interest rates go down in the market. Well, as they go down, that coupon, that fixed coupon, stays the same. It stays fixed. And in comparison or in relation to current interest rates in the market, it's becoming more and more attractive, giving rise to bond price appreciation, because investors find this bond kind of overly attractive as compared to current market conditions. So they're willing to pay a higher and a higher price for the bond. However, not in the case when that bond can be called back by the issuer at the next potential date, as specified in the schedule. That will cap, effectively, it caps the price to which the bond can go up. Right. What else? However, right, one point which is I guess positive. Whenever you're introducing a feature into a bond which is detrimental to the investor, you have to compensate the investor for that. So to compensate the investor for taking that risk, you're going to offer a higher yield on the bond, a higher rate of return. So that could happen via a higher coupon, a coupon which is higher than what you would find in a bond without the call feature, but similar parameters. Or it could be due to the fact that the price of the bond is lower, so investors are willing to buy it, but for a lower price, making the rate of return higher. As you can hopefully appreciate, when you pay a lower price for something, you make your rate of return on the investment a higher one. Now, let me just say that there is a second type. Where am I going to put this? I knew this could be potentially a bit of a struggle. So over here, second type of these callable bonds, or the way we specify the call price, and that's a make whole call. It's a bit of a mouthful, isn't it? Make whole call. And it's different to this one. It's different to the fixed price call. Here, you don't know upfront what the price at which the bond is going to be called is. So it's actually a floating price. This one allows the issuer to call the bond. So once again, redeem it ahead of the official schedule or the official maturity date, but the price is based on current yield to maturity. So current cost to refinance, or the rate of return required in the market currently, typically taken from sovereign, meaning government bonds, plus an adjustment for some, a credit spread in the case of credit corporate issuers. And okay, what's this all about? It's about making sure the price doesn't stay fixed. And if interest rates in the market do indeed go down, as they sometimes do, what will happen is you'll compute a price, but it's based on the current level of interest rates. And because bonds work, or bond valuation happens using discounting mechanisms, so we take the cash flows promised by a bond and we discount them over time using an interest rate to compute what's known as present value, which becomes the price of the value of the bond. When interest rates go down, the effect of discounting becomes smaller. The lower the interest rate is, the less the discounting has an effect, making the bond price actually higher. So, to cut a long story short, lower interest rates in the market lead to higher call price. So it's a price which actually goes up as interest rates drop. And this is not going to be something which allows, the issuer to replace an existing bond with a higher coupon for a bond at lower, paying lower coupon, because the price you'd have to pay to redeem the bond, the call price, becomes so high potentially that it doesn't really make sense to make that replacement anymore. So this is used, it's not used to lower the cost, essentially, because of the higher price you'd have to pay in a lower interest rate environment. It's issued, this type of bond a bond with this type of make whole call provision, issued mainly by high quality issuers. So issuers who have a very good position, rating, financial standing in the market. And as I said, if interest rates go down, the call price increases, making it prohibitively expensive to actually redeem the bond. So you wouldn't do it, you wouldn't exercise the option. But what it does give you is it gives the issuer just some flexibility if they need to redeem the bond, and therefore, lower their debt, for example, flexibility to redeem early, but it's not a way to potentially save on costs associated with servicing the bond. Okay, the next type of option, embedded option, which may be built into bonds, is a put option. And if such an option exists, that makes the bond a putable one. So this gives rise to putable bonds. I think a bit less common than convertible ones, the ones that we discussed before. And in this case, it's not the issuer, but it's the investors who have the option to do something. Investors have the right to sell or put the bond back to the issuer. And once again, they can do so ahead of the official maturity date. And once again, this happens ahead of the maturity date at a predetermined price. That price is once again going to be written into the bond agreement, into the bond contract. And in this case, it will typically be equal to the bond's par value. So this is a way to accelerate when the investor receives the par value, not necessarily having to wait until the official maturity date. This one, because it gives a certain rights to investors, it's going to be favorable or valuable to for the investor. For investors, especially, we're all the time here talking about bonds which pay a fixed coupon. So if a bond pays a fixed coupon, and subsequent to its issue, interest rates in the market start going up, this is a way for that investor, if interest rates start going up, to basically recover their money earlier, be able to reinvest at a better rate in some new issue. Because what happens is normally when interest rates start going up, a bond which has already been issued with a fixed coupon kind of gets stuck behind paying its original coupon. As interest rates go up in the market, that bond becomes less attractive as compared to current market conditions, and of course its price drops. Well, in this case, if investors go up, normally, let's say, the price of fixed coupon bonds normally goes down, but not in the case of this one, because here the put option effectively provides a bit of a floor for the bond's price, stopping it from falling below that value, because the investor can always put the bond back and receive that fixed floor. And obviously, when they receive the money, they can reinvest that money at a higher interest rate. However, because the investor is getting something favorable, investors should expect, as a consequence of getting something favorable, a lower yield. Right? You can't get a very good yield on such a bond, or not as good a yield than you would on a similar bond with similar parameters, but without the put option. There's always a question of something for something. Now, the final type of option that we need to talk about is a conversion option. So, of course, as you may have guessed, if a bond contains a conversion option, it becomes a bond that is convertible. So let's write this name down, convertible bonds. Okay, and what these allow is they allow bondholders, so the investors, they have the right to exchange the debt or the bond for equity. And the way this happens is you'll be told that this exchange can happen for a specific number of shares, and it's the shares of the same issuer, the same company that issued the bonds. This happens at a, and this is an important one, at a predetermined. So once again, everything here is agreed up front, predetermined, so-called conversion price. And this is something you need to be comfortable with, this conversion price idea. Your curriculum contains some very light numerical examples. Let me kind of show you how this works. So example over here, let's say you have a bond with $1,000 of par value. 1,000 par value bond may be converted into shares, into ordinary shares of the issuer, so common stock, and you are told a price at $50 per share. So that $50 per share would be your conversion price over here, right? And from this, in a moment, we'll try to compute a conversion ratio, which is actually very, very simple. So let's take a timeline. And over here, we've got the maturity date that's built into practically every bond. And on the maturity date, what the investor can do, investors have the right to decide whether they want to receive the $1,000 of par value, the cash, or do they want to go for shares? Now, shares with a certain conversion price. And the question is, how many, right? Well, you can easily compute this by turning this conversion price and the par value, using those two to compute a conversion ratio. And that's something you may be asked to do in the exam. If so, it's really easy. The conversion ratio, right, is the par value of the convertible bond divided by the conversion price. So here you may exchange the receipt of $1,000 into shares at a price of 50 per share. So 1,000 divided by 50 would give you access potentially to 20 shares if you wanted to. So here I can say 20 shares. That's the significance of the conversion ratio. It allows you to compute that relationship, or the number of shares you can get in exchange for giving up the par value, not receiving this. And it's, let me stress, this is up to the investor to decide whether they want one or the other, and they don't have to decide at the very beginning. No, you can decide quite close to the maturity date. You know, there will be a cutoff point when you need to make that decision. And look, this option creates a very interesting sort of perspective. Depending on the current share price and whether that share price is below or above the conversion price of 50 in our example. So 50, but this is simply the conversion price. Our decisions with regard to what we would do change diametrically, because if the price is below the current share price, if it's in this territory, meaning, you know, below the conversion price, well, you would choose the 1,000. So, you know, it would be better to receive $1,000 than 20 shares, which are in the market worth less than $50. So you could say that over here in this territory, the bond behaves in terms of its price like a standard bond, a non-convertible bond without any built-in features. However, as we get closer and closer to that 50 in terms of the current share price, the bond starts to, you know, gain in value, because you're getting closer to the territory where you've got a lot of potential for upside. We call this upside potential. And over here, in this territory, it becomes obvious that you would go for the 20 shares, which now have a higher value, because you're effectively buying them for a lower price, 50, than their current market value. And you could say that in this territory over here, the value of the bond starts to approximate, you know, it's not necessarily equal because of features of optionality, but it starts being that whatever is the conversion ratio, in our case, 20 shares times the current share price. Because you already know you're going to go for the shares, the 20 shares, and the bond is aware of however much the conversion ratio times the current share price gives. And this has a name, which I want you to stick into your heads, right? This relationship, conversion ratio times current share price, this is known as conversion value. So in the exam, you may potentially be asked for conversion price, conversion ratio, or conversion value. This is the value if bondholders chose to convert. Value if bondholders choose to convert. Okay, now let's think about more generically what this is, where this is going to be used. Convertible bonds, so bonds which contain this kind of feature, obviously because they contain something which is positive, favorable for the investor. Let's say this over here, are favorable for the investor. They provide this so-called upside potential here, right? Which is not going to be the case with straight, normal, non-convertible bonds. And because of that, because you know that you're giving something extra to investors, potentially beneficial, they're going to absolutely have to accept a lower yield, a lower rate of return. You have to pay for this either via the coupon being much lower than on a normal bond, or the price that you need to pay for this bond being much higher. So lower yield, e.g. a much lower coupon. So now appreciate that this type of bond may be issued by an issuer, by a company that would normally have trouble paying a standard coupon on its bonds, given current market conditions. But because they embed a conversion option into their bonds, so they make it potentially beneficial if the share price goes up. This conversion, option may gain a lot of value. That allows them to currently in the market offer a bond with a much lower coupon than would be the case without the conversion option. Let me now quickly tell you about an alternative to convertible bonds. And that's going to be for a company to issue a bond, but with an attached warrant. Issue bonds with attached warrants. Now, warrants are options to buy shares, but it's not an embedded option. Not embedded. A warrant is an option that is detachable from the bond. So warrants are detachable. Detachable options to buy shares. And obviously at a fixed price in the future. So just like you would have with a conversion option that's built into a bond that contains a conversion price that allows you to exchange the par value for a fixed number of shares at a conversion ratio, which is a function of the par value and conversion price. Here you've got a fixed price that is built into the warrant, but once the bond is issued with a warrant attached to it, you can detach the warrant, which you normally do, and the warrants themselves trade as separate instruments on the exchange. But because you're building something extra, you're attaching something potentially valuable, this warrant, into what is otherwise a standard bond, you're going to be offering investors something more favorable, which once again is a way to lower the coupons that you pay on a bond, or perhaps sell a bond with a standard coupon but for a higher price because of this extra feature. Okay, I want to tell you, because this is discussed in the curriculum, about a very special type of convertible bond. So this is by no means a standard thing, special type of convertible bond. It's called a contingent, or they are called contingent convertible bonds. And if you combine the CO over here, you get their sort of market name, the CoCo or Cocoa bonds. That's how they are often called. They are typically issued by banks, especially in Europe. They're sometimes called AT1 bonds. You may have heard that name in the context of Credit Suisse and its trouble. Well, I'm not going to really talk about that. But what happens here is these types of bonds, they convert to equity because convertible bonds generally do. They convert from debt to equity, but not when the share price goes up, but on the downside. However, downside means trouble here, but very importantly, the trigger for the conversion is not the share price itself going down, but some other trouble, happening. And when you put this in the context of banks, it's typically built in such a way that conversion into shares, conversion into equity is automatic once a certain condition is met or a specified event occurs. So it is automatic upon a specified event. And these types of bonds have hugely extensive documentation describing these triggers, and they're much more complex and complicated than standard bonds. So upon a specified event, and this is often the capital ratio, which is an expression of how much capital a bank has, going down below a certain threshold level. And capital is another way for equity. And basically, when banks suffer losses, their equity goes down, their amount of capital goes down. And one thing you will learn from your studies of financial statements analysis, FSA, in the CFA exam, is that equity is something that's contributed into a company, or in this case a bank, by shareholders, by investors, by owners. And one of the economic roles of equity is to absorb potential losses. So when losses do occur, the amount of equity goes down because it acts as a cushion, as an absorber, as a buffer, and you need to rebuild that equity layer. And one way to do this is to force a conversion from debt to equity by specific bondholders. And because of this automated conversion, this gives a boost to equity. So you kind of automatically recreate your cushion, your buffer, which suffered a drop due to losses. Now, being a holder of these contingent convertible bonds puts you at a lot of risk. When something bad happens in banks, these things automatically convert to equity, but it's the wrong time to be an equity holder, because it's not because the situation is great, like with classic convertible bonds, when you would convert when the share price goes up. Here, it's on the downside. When something bad happens, you are forced to convert. It's like being, it's like being taken into the army because a war has started. Obviously, that's not the best situation to be in. It's like here, we're in trouble. You get converted into a shareholder. You're no longer a bondholder. So this gives a boost to equity, but it exposes this kind of, bond exposes investors to high risk. And as a result, investors want to be compensated for that higher risk with higher yields. So this is unfavorable for investors. So they need to be compensated for it with a good coupon. Typically. Right. And one more thing, very important. I'm saying it at the very end, but it is important. When you think about yields, i.e., rates of return that investors expect from different type of bonds, the more favorable you make the bond for the investor, the lower yield they should expect. So yields are going to be low when you give something extremely good, something extremely favorable, and it doesn't get any more favorable typically than convertible bonds. So because convertible bonds offer that exciting potentially perspective of converting into equity, which may be worth a lot, typically what you need to pay these types of bondholders is not going to be a lot because they don't expect a higher yield. However, yields become bigger as we move towards those bonds which put investors at a disadvantage. However, let's mention that with putable bonds, putable bonds are still favorable for the investor, so maybe not as favorable as convertible bonds, although it really does depend on the terms of the conversion. But your curriculum says, lowest yields for convertible bonds, but as we go to putable bonds, the yields should be a bit higher. However, yields ought to be high when we get to callable bonds, because callable bonds work against the investor when interest rates go down, and normally prices of bonds with fixed coupons should be going up. These bonds can be called back for a fixed price, so they work against the investor. So the yields offered on such instruments should be high to compensate the investor for the additional risk. And your curriculum doesn't really treat CoCos or contingent convertible bonds, CoCos, as a category to put in here. Probably they would be to the right of callable bonds, but once again, that depends on the specific situation of the institution that issued the bonds and how close and how probable it is that it may get into the trouble that will trigger such a conversion.